Hi everyone, welcome to your first project. I would like to introduce you to some basic concepts that I think might be important for you to have a brief understanding of before you tackle project 1. I'm going to share my screen with you so that you have a better understanding of the different aspects in this particular project. Right, so really, this topic is all about sharing and understanding the different financial statements that you have in an organization. Now, why do we have these? Because there's a whole bunch of people, stakeholders, that are interested in our organization. There's a list. Financial statements are usually prepared in terms of generally accepted accounting practices, which is our guidelines of exactly how and what we should put into our financial statements. Now, our financial statements in accounting really is summarized into, you can roughly say, 3. Your balance sheet or statement of financial position, your income statement or your statement of financial performance, and your cash flow statement. Each of these statements serves a different purpose. Your balance sheet typically tells us everything about what the company owns and what it owes during a particular period in time. The items that it owns we refer to as our assets, and the items that are owed are referred to as basically in 2 categories: our liabilities, which are debt to third parties, and our stockholders' equity, which really is the money that is effectively owed to the owners of the organization, although they will never really claim that money back from the organization. At best, they can sell their shares and we can get new owners. What is net working capital? This is an important concept in the balance sheet, and it is the difference between our current assets and our current liabilities. Current assets are assets which we usually have in the organization for periods of less than 12 months. And we usually find typically 3 current assets: our bank or cash and cash equivalents, our accounts receivables, that is the customers who we sell to on credit, and then our inventory, which consists again of, it can be finished goods, it can be raw materials, it can be work in process, or a combination of these. Current liabilities refer to liabilities which we have for periods shorter than 12 months, and that is typically our suppliers or a bank overdraft. Now, basically, our current assets are listed in the order of liquidity, so from the most liquid to the least liquid, and then basically liabilities in the way that we will pay them, and stockholders' equity is always listed last. Our income statement. In our income statement, there are a couple of important items. The first one is our revenue. Some people refer to this as our sales. And the revenue, less the cost directly related to creating that revenue, usually results in our gross profit. Some people call it the gross margin. Our expenses are typically, other expenses appear after that. We usually take our gross profit and we subtract all our other expenses. And that could be things like our general admin expenses, our selling expenses. That will then give us our operating income. Once we subtract from our operating income our taxes and our finance charges, we get to our net income. Remember, our finance charges is just another word for interest. So typically, our income statement measures our profitability. And to do that, we look at the overall income, which is the difference between the revenue or the income and all of the expenses in the organization. There's a typical example of a company where you can see we start with the net sales, we subtract the cost of goods sold, we then can end up with or subtract our selling and admin expenses, and then end up with our earnings before interest, tax, depreciation, and amortization. And that is what EBITDA stands for. Once we subtract the depreciation and amortization, we end up with the EBIT, earnings before interest and tax. And once we subtract the interest expense, we end up with EBT. We then only have to subtract our taxes to end up with our net income. The income statement is usually the place where you find your depreciation. We reduce the physical cost of an asset by writing off annually the amount of that product that we used up. And we usually refer to that as depreciation. We get depreciation and can calculate that through different methods. Straight line depreciation is typically where we use the lifespan of the asset to actually determine how much the actual asset reduces with each year. These usually only apply to our non-current assets. And non-current assets are typically things like your vehicles, your machinery, your equipment. Now, on the items which we usually call intangible assets, so those are assets which also have a lifetime of longer than 12 months, we usually write them off by using amortization. Typical examples of intangible assets, in other words, assets which we can't touch, but that still has value to us, are things like your goodwill, your patents, your license fees. Again, there's just to draw your attention to the terms EBITDA and EBIT, which are two very different terms. Now we get to the cash flow statement. The cash flow statement typically explains to us why the cash in the business has changed from the beginning of the year to the end of the year. And this calculation you can usually find in the cash flow statement. The cash flow statement typically consists of three categories: your operating activities, your investing activities, and your financing activities. Operating activities is literally how much cash did I make from my operations. In other words, from buying and selling my product, for example, or delivering my service. Investing activities look at how much money did the business either put into buying new assets or effectively gain from selling a specific asset. Sometimes when businesses no longer need the assets, they will typically sell the assets, and that can generate cash for them as well. And lastly, another place where we can get cash from in a business is through financing. Typically, if I enter into a loan in the beginning, when I actually get the money in the first year, that money will be money flowing into the business and will actually be a source of cash or generate cash or be a positive cash inflow to my business. However, in the subsequent years, when I've got to start paying back that loan, that repayment of that loan will require an outflow of cash. Typically, your cash flow statement is about, is it money coming into the business or is it money going out of the business? And with each of these categories, we will look at that. So, for example, when your tax figure reduces from one year to the next, it means you are paying tax, which means it requires money to flow out of the business. So it will be a negative amount. It will reduce your cash flow. However, when we are actually looking at basically something like our inventory, if your inventory figure increases from one year to the next, so from last year to this year, if my inventory has increased, it can only increase because I spent more money on my inventory. And therefore, if I'm spending money, it means an outflow again of cash in my business. There's a couple of examples. As I said, our investing activities is about buying and selling long-term assets. Buying reduces cash. Selling our assets brings cash in. Typical cash inflows in financing: when I borrow money, when I issue shares, when I issue debt, that brings money into the business short term for the year. But then with the moment I start repaying them, that reduces the cash. There's just again an example of a cash flow statement. And the important thing to notice here is that I start basically with my cash flow at the beginning of the year, and I look at the cash flow at the end of the year, and that difference between the two is usually explained through how much I got from my operations. In this case, it's a positive figure, so it's money coming in from operations. But then how much am I spending on investing activities, because it's an outflow? And then lastly, again, I'm getting some money in from my financing activities. So if I'm going to take all the inflows, so the inflow from operating plus the inflow from financing, less the outflow from my investing activities, then it will explain to me that particular difference there, which is the net increase in my cash flows for the year. I hope you find this useful. I will also give you a short video on financial statement analysis.